Welcome back. Today, we are diving into an absolutely hardcore analysis of the most talked about private giant in the US tech and AI infrastructure space right now. Give me just 8 to 10 minutes, and I guarantee I'll save you at least 2 hours of reading through dry earnings transcripts. We're tearing apart CoreWeave's Q1 2026 numbers today. And right off the bat, we are staring down a massive paradox. I mean, just imagine this. A company literally doubles its revenue year over year. They're sitting on epic, history-making demand. But in that exact same breath, their operating margins fall off a cliff. What in the world is going on behind the scenes here? Let's jump right in and figure it out. First up, we gotta talk about the sheer, mind-blowing scale of this demand explosion. CoreWeave's Q1 revenue hit $2.07 billion. That's a 112% jump year over year. But the real jaw-dropper here? It's their revenue backlog. In just this one single quarter, they added over $40 billion in committed orders. That pushes their total backlog to a staggering $99.4 billion. Guys, that's nearly 4 times what it was last year. If anyone thought the demand for compute infrastructure was slowing down, well, this completely shatters that narrative. But here is where the paradox hits. Take that massive $99 billion backlog and put it right next to this number, 1%. Despite this unbelievable revenue growth, CoreWeave's adjusted operating margins completely crashed to just 1% in Q1. That's a mere $21 million in adjusted operating profit. And their net loss actually widened to $740 million, largely driven by the massive interest expenses from building out all this infrastructure. So this leaves us with a giant mystery, right? If demand is literally making history, why did their profits completely bottom out? To solve this mystery, here is our game plan for today's explainer. First, we'll unpack this demand explosion. Second, we're going to crack the profit mystery. Third, we'll look at their tight partnership with Nvidia and their infrastructure moat. And finally, we'll map out their layout for 2026. All right, Chapter 1, the demand explosion. You know, when you see a number like $99.4 billion, it's really easy to just brush it off as some pie-in-the-sky dream decades down the road. But this money is actually highly concentrated in the near term. Looking at the data, 36% of this backlog is expected to be recognized as actual revenue within the next 24 months. Another 39% hits between months 25 and 48. So the absolute key takeaway here is that 75% of this massive pipeline is going to hit the books in just the next 4 years. This gives CoreWeave incredibly rare, highly predictable short-term cash flow. And what's really fascinating is they aren't just relying on a handful of hyperscalers anymore. CoreWeave is aggressively expanding who they sell to. They've pushed hard into the financial services sector, which now accounts for nearly $10 billion of that backlog alone. Physical AI and spatial computing, that just crossed the $1 billion mark too. Plus, in Q1, they officially brought Anthropic on board and inked multiple massive deals with Meta, including that jaw-dropping $21 billion agreement announced in April. Their customer ecosystem is just expanding horizontally at breakneck speed. Which brings us to Chapter 2, the profit mystery. Okay, so to understand why those margins tanked to 1%, we need to quickly translate a bit of industry jargon. The key to cracking this whole puzzle is something called a powered shell. A powered shell is essentially just an empty data center facility. It's got the physical building, the massive power contracts, the network connectivity, but absolutely zero servers, GPUs, or racks installed yet. Keep this concept in the back of your mind because it literally dictates how CoreWeave's short-term and long-term costs play out. So here's the deal. This margin squeeze is purely a timing issue. Their underlying unit economics are not broken. When CoreWeave acquires a powered shell, Step 1 kicks in immediately. They have to start paying hefty lease and power costs right away. Then comes Step 2, the fit-out process. This takes about 1 to 2 months. During this window, they are frantically installing servers and testing GPUs. They're eating massive equipment depreciation costs, but generating exactly $0 in revenue. It is a straight-up cash burn. But then we hit Step 3. Usually by month 3, the capacity goes live, the revenue starts flooding in, and their contribution margins snap right back to a healthy mid-20s%. So Q1 was just heavily dragged down by a huge wave of Step 1 and Step 2 expansions. Management fully expects margins to grow quarter over quarter as this capacity comes online, normalizing back to double digits by the end of 2026. Now, before we dive into CoreWeave's ultimate competitive moat and their insane capital expenditure plans, I want to take a quick second. If you are an investor who values cutting through the market noise to get deep, actionable insights into U.S. tech stocks just like this, make sure you hit that subscribe button. I update the channel every single week with explainer content designed to actually save you time and keep you ahead of the curve.
All right, let's keep moving. Chapter 3, Nvidia and the Infrastructure Moat.
Recently, Nvidia officially designated CoreWeave's software solution as a reference architecture. Now, in this space, that is a massive heavyweight endorsement. It proves that CoreWeave isn't just buying hardware and acting as a glorified middleman or landlord. Their actual software management and orchestration of AI infrastructure has been completely validated by the absolute king of the industry. That is an incredibly powerful stamp of approval and a huge competitive advantage when they're out there trying to win over giant enterprise clients. Another really interesting dynamic we need to look at is how this compute is actually being used. We're seeing a critical shift right now. Based on power consumption estimates, inference workloads now make up over 50% of CoreWeave's compute usage. Why does that matter to us? Because this massive demand for inference beautifully extends the life cycle of older generation GPUs, like the A100s. You don't always need the absolute bleeding-edge hardware to run inference. That being said, demand for top-tier chips like the H100 and H200 is still so incredibly strong that they remain completely sold out. In fact, overall pricing is actually trending up quarter over quarter. The market's hunger for compute is absolutely not slowing down. And to support all this hardware, they are building a very real infrastructure moat. CoreWeave currently operates across about 50 distributed data centers worldwide. But here's the brilliant part. They've structured their supply chain so that no single data center provider accounts for more than 17% of their active infrastructure. They're also using multiple different hardware manufacturers. Right now, they've successfully locked in over 3.5 gigawatts of contracted power. In a market where power availability is a massive bottleneck, this aggressive diversification drastically lowers the risk. Which leads us perfectly into our final chapter, the 2026 layout. In Q1 alone, they dropped $6.8 billion on capital expenditures, but management just bumped their full year 2026 CapEx guidance to an unbelievable $31 to $35 billion. And the reason they raised the lower bound of that guidance is exactly because component pricing in the supply chain is getting tighter and a lot more expensive. By spending aggressively right now, backed by the $20 billion in debt and equity they've already raised this year, they are strategically locking in component pricing and infrastructure capacity to protect their future unit margins. And all that massive spending, it is already delivering locked-in growth. CoreWeave noted that their 2026 capacity is practically entirely sold out at this point. They've upgraded their annual recurring revenue, or ARR, target for the end of 2026 to between $18 and $19 billion. But here's the craziest part. Their ARR target for the end of 2027 is over $30 billion, and more than 75% of that 2027 target is already officially contracted. The long-term revenue visibility this company has right now is honestly unprecedented. So looking at that mountain of a $99 billion backlog and their aggressive debt-fueled infrastructure expansion, I want to leave you all with two questions today. First, do you think CoreWeave's multi-billion-dollar CapEx expansion is a brilliant, unassailable moat, or is it a massive, risky bet if the AI supercycle suddenly stalls out? I really want to hear your detailed takes, so let me know down in the comments. And question number 2. Which U.S. tech stocks earnings or strategy should we unpack in our next explainer? Drop your wish list in the comments below. Thanks so much for hanging out with me today, and I'll catch you in the next explainer.